Investing in multifamily homes can be an attractive option for real estate investors seeking to generate cash flow, diversify their income, and benefit from long-term appreciation. Multifamily homes offer several advantages, including economies of scale, lower risk of vacancies, and potential tax benefits. In addition, with increasing demand for rental housing and changing demographic trends, multifamily homes have become a sought-after asset class for many investors. This video will provide a comprehensive overview of investing in multifamily homes, including multi-unit property analysis, financing options for multifamily real estate investment, risk management, and exit strategies. By the end of this course, you'll have the knowledge and skills to successfully invest in multifamily homes and build a profitable real estate portfolio. Let's start by an overview of multifamily homes and their types. Multifamily homes refer to residential buildings that are designed to accommodate more than one family or household, typically with separate units or apartments. Multifamily homes have become an increasingly popular investment opportunity for real estate investors seeking to generate stable cash flow, diversify their income, and benefit from long-term appreciation. There are several types of multifamily homes, including apartment buildings, condominiums, townhouses, duplexes, triplexes, and mixed-use developments. The primary characteristic of multifamily homes is that they provide multiple independent living spaces within a single property, making them an attractive investment option for investors seeking economies of scale and lower vacancy risk. One of the most significant advantages of investing in multifamily homes is cash flow potential, which can be generated from rental income. Multifamily homes can also provide diversification of income, long-term appreciation, and potential tax benefits. Additionally, with increasing demand for rental housing and changing demographic trends, multifamily homes have become a sought-after asset class for many investors. Market trends suggest that demand for multifamily homes will continue to increase due to demographic shifts and housing needs, emerging technologies and amenities, and regulatory and policy changes. As such, investing in multifamily homes can be a lucrative and profitable venture if done right. Okay, now that we talked about advantages of investing in multifamily homes, let's discuss multifamily investment analysis. Conducting a multifamily investment analysis and identifying potential multifamily properties involves several steps, including market research, financial analysis, and due diligence. The first step is market research. Start by researching the local real estate market to identify areas with strong demand for rental properties. Look at demographic trends, employment growth, and population growth to determine if there is a healthy demand for rental housing in the area. In the U.S., there are several tools and resources that can be used to run market research for multifamily real estate investing. Here are a few options. Explore Realtor.com, Zillow.com, and Redfin.com. These online real estate platforms offer data on home values, rental prices, and market trends by zip code or specific areas. They also provide information on comparable sales, active listings, and other important data that can help investors evaluate the potential value of a multifamily property. Local newspapers and business publications. Local newspapers and business publications can be a valuable source of information on local real estate market trends, upcoming developments, and economic factors that can affect demand for rental properties. You can access these publications online. Census Bureau. The U.S. Census Bureau provides a wealth of data on demographics, population growth, and housing trends at the national, state, and local levels. This information can be used to evaluate the demand for rental housing in a specific area and help investors identify potential investment opportunities. CoStar. CoStar is a commercial real estate research platform that provides data on multifamily properties, including sales, lease rates, and market trends. This platform can be particularly useful for investors looking to analyze properties in larger markets or metropolitan areas. Real estate agents and brokers. Real estate agents and brokers can provide valuable insights into local real estate markets, including current market conditions, supply and demand trends, and other important factors that can affect the value of multifamily properties. Overall, there are many tools and resources available for conducting market research for multifamily real estate investing. By using a combination of these resources, investors can gather the information they need to make informed investment decisions and build a successful real estate portfolio. Let's move on to the second step. The second step is property analysis. Once you've identified potential areas, analyze individual properties by examining factors such as location, size, number of units, condition of the property, and amenities. You should also consider factors such as the age of the property, any potential renovations or upgrades needed, and the competition in the area. To evaluate the location, consider factors such as the neighborhood, proximity to public transportation, schools, parks, and shopping centers. Properties in desirable locations with strong demand for rental housing are more likely to appreciate in value and generate strong rental income. Analyze the size of the property and the number of units to determine the potential rental income. Properties with more units typically generate higher rental income, but may also require more maintenance and management. Evaluate the condition of the property, including the age of the building, any needed repairs or upgrades, and the overall quality of the construction. Properties in good condition are less likely to require costly repairs and may generate higher rental income. Check the amenities of the property. Consider any amenities offered by the property, such as a pool, fitness center, laundry facilities, or parking. Properties with desirable amenities are more likely to attract and retain tenants, which can result in higher occupancy rates and rental income. Also, you need to assess the competition in the area, including other multifamily properties and single-family rental homes. Properties in areas with low competition may be more attractive to tenants and generate stronger rental income. The third step is financial analysis. Evaluate the financial potential of the property by analyzing its income and expenses. Calculate the net operating income, NOI, of the property by subtracting operating expenses from the gross rental income. You can use the NOI to calculate key financial metrics such as the cap rate, cash-on-cash return, and internal rate of return, IRR. Here are some additional details on the key financial metrics that we just talked about. Net operating income, also known as NOI, is calculated by subtracting the operating expenses from the gross rental income. This metric is important because it shows the income potential of the property before accounting for debt service. Capitalization rate, also known as cap rate, is calculated by dividing the NOI by the property's purchase price or value. This metric is important because it helps to determine the potential return on investment for the property. Generally, higher cap rates indicate higher potential returns. Cash-on-cash return is calculated by dividing the property's annual cash flow by the amount of cash invested in the property. This metric is important because it shows the cash return on investment for the property. Internal rate of return, also known as IRR, is a more complex financial metric that takes into account the time value of money and the expected cash flows over the holding period of the property. This metric is important because it shows the overall return on investment, including any appreciation or cash flow on the property. When conducting a financial analysis, it's important to use accurate and realistic data for both income and expenses. This can include factors such as rental rates, vacancy rates, property taxes, insurance costs, maintenance and repairs, and management fees. By carefully analyzing the financial potential of a multifamily property, investors can make informed decisions about whether or not to pursue an investment opportunity. The fourth step is due diligence. Before making an investment, conduct due diligence on the property to ensure there are no hidden issues that could negatively impact the investment. This can include a property inspection, reviewing leases and rental history, and examining any potential legal or regulatory issues. So, what are the main components of a due diligence process? Here, we discuss some of them. Property inspection. A property inspection is a thorough examination of the physical condition of the property. This can include inspections of the building structure, mechanical systems, plumbing, electrical systems, and appliances. The inspection can identify any issues that need to be addressed before closing the sale. Reviewing leases and rental history. Reviewing the current leases and rental history can help identify any potential issues or risks associated with the property. This can include identifying any delinquent rents, past evictions, or lease violations. It can also help to determine if the property is currently generating the expected level of income. Examining legal and regulatory issues. It's important to examine any potential legal or regulatory issues associated with the property. This can include reviewing the property's zoning and land use designations, examining any environmental concerns, and checking for any outstanding liens or legal disputes related to the property. By conducting a thorough due diligence process, you can identify and mitigate any potential risks associated with the property. This can help to ensure a successful investment and minimize the potential for unexpected issues or expenses down the line. And finally, the fifth step is financing options. Once you've identified a potential property, consider your financing options. Multifamily homes can be financed through traditional mortgages, private lenders, or other financing options such as commercial loans or crowdfunding. Let's explore them one by one. Traditional mortgages. Multifamily properties can be financed through traditional mortgage lenders such as banks, credit unions, or mortgage brokers. These lenders typically require a down payment of 20% or more and have specific underwriting requirements related to the property and the borrower's financial history. Private lenders. Private lenders can also provide financing options for multifamily properties. These lenders can include individuals or private investment groups who are willing to lend money at higher interest rates than traditional lenders. Commercial loans. Commercial loans are another option for financing multifamily properties. These loans are typically offered by commercial lenders and can have different underwriting requirements than traditional mortgages. Crowdfunding. Crowdfunding is a relatively new financing option for real estate investments. This option allows multiple investors to pool their money together to fund a real estate project. Crowdfunding can be a good option for investors who don't have enough capital to invest in a property on their own. When considering financing options, it's important to understand the costs associated with each option, including interest rates, fees, and potential down payments. By carefully weighing the costs and benefits of each financing option, you can make informed decisions about how to fund their multifamily real estate investment. Overall, conducting a multifamily investment analysis and identifying potential properties requires careful research and analysis. By evaluating key factors such as market demand, property condition, financial potential, and conducting due diligence, you can identify strong investment opportunities and build a profitable real estate portfolio. Now, let's explore risk management considerations. Risk management is an important aspect of multifamily real estate investment. By implementing these risk management strategies, you can help protect your multifamily investments from potential losses and ensure the safety and security of your tenants. Here, we discuss some risk management strategies that you can use to protect their investments. Number 1. Purchase insurance. Insurance can help protect multifamily properties from a variety of risks, including property damage, liability, and loss of rental income. Investors should consider purchasing property insurance, liability insurance, and rental income insurance to ensure they are protected from potential losses. 2. Have a disaster preparedness plan. Disaster preparedness is another important risk management strategy for multifamily properties. Investors should develop plans for how to handle potential disasters such as fires, floods, and earthquakes. This can include having emergency supplies on hand, developing evacuation plans, and ensuring that the property is up to code with safety and building regulations. Number 3. Consider security and safety measures. Security and safety measures can help reduce the risk of crime and other safety hazards at multifamily properties. This can include installing security cameras, hiring security personnel, and ensuring that common areas are well lit and secure. It's also important to educate tenants on safety measures and to have emergency response plans in place. It's important to regularly review and update these strategies to ensure they remain effective in the face of changing risks and circumstances. We're now going to shift gears and talk about different exit strategies in multifamily investing. Multifamily real estate investments can provide long-term passive income and appreciation for investors. However, it's important to have a plan for exiting the investment when the time comes. There are some common multifamily investment exit strategies. The common one is selling multifamily homes. Selling the multifamily property is one of the most common exit strategies for investors. This can be done through a traditional sale, auction, or sale to a real estate investment trust or REIT. When selling a property, investors should consider factors such as market conditions, property condition, and potential tax implications. The second common option is 1031 exchange. A 1031 exchange is a tax-deferred exchange of one investment property for another like-kind investment property. This can be a useful strategy for investors who want to reinvest the proceeds from a sale into a new property without incurring capital gains taxes. It's important to note that 1031 exchanges have specific rules and timelines that must be followed to qualify for tax deferment. Investors should work with a qualified intermediary or tax professional to ensure they are following all of the necessary rules and regulations. The third option is estate planning. Estate planning is another exit strategy that can be used to transfer ownership of the property to heirs or other beneficiaries. This can include setting up trusts or other legal structures to ensure a smooth transfer of ownership. Let's summarize what we discussed in this video. Investing in multifamily homes can be a lucrative and rewarding strategy for building long-term wealth. Multifamily properties offer several advantages over other types of real estate investments, including the ability to generate stable cash flow, diversify risk through multiple units, and leverage economies of scale to increase profitability. You can identify potential investment opportunities, conduct thorough property and financial analyses, and manage risks through insurance, disaster preparedness, and security measures. Additionally, there are several exit strategies available for you, including selling the property, utilizing a 1031 exchange, and estate planning. We covered several topics in this video. To recap, in this video, you learned about multi-unit property analysis, financing options for multifamily real estate investment, risk management, and exit strategies. Thanks for watching.